In this video, I'm going to cover the optimum salary for company directors for the financial year 2024-2025. And the question I'm going to be addressing is, what is the most tax-efficient salary for a company director in the financial year starting 6th of April 2024 to 5th of April 2025? I'm going to show you how to pay yourself in the right way so that you can maximize your tax savings. My name is Lenah Oduor. I'm a chartered accountant and founder of gHawk Accounting. We are a UK-based accounting firm helping small business owners take control of their finances so that they can have more money, time, and freedom. So let's get started. So here is an outline of what we will cover in this session. We will first start by looking at why it is so important to look at matters of paying yourself at the beginning of the financial year rather than waiting to the end of the financial year. We'll then cover an overview of the key taxes that come into play when you're paying yourself from a company. And this is income tax, national insurance contributions, employment allowance, corporation tax, and dividends tax. I'll then give you my personal recommendation for the salary that you need to pay yourself with backing of why this is the right amount and how this impacts both you and the company. And in part 2 of this video, I will take you through some 4 worked examples at different levels of income, just showing you the impact of paying yourself in different ways versus the impact it has both on you as a director, plus also on your company. But before we get stuck in, I want to give a disclaimer that matters of tax are very complex and nuanced. This information is educational and of a general nature. Check with your accountants that this works for you before you start to implement it, and because some of it might not be appropriate based on your personal circumstances. So why is this important to think about at the very beginning of the financial year? First of all, is that you and the company are separate legal entities for corporation tax, for tax purposes. And even if you're the owner of the business, you cannot just take out all the profits that the company makes. A sole trader can do that, but in a limited company, you must have a structure of paying yourself, because the money that is in the business is not necessarily yours. The best way to pay yourself is a combination of salary and dividends, and I'll show you why that is the case. The most important aspect of this payment method is you could save thousands of pounds over the years simply by implementing this strategy. So it's important to get it right from the very beginning and keep doing it year after year. And before you know it, the benefits are going to accumulate. So let's start with income tax. Income tax is deducted from your salary before you receive your net pay. And it is important to know what the rates are. So every UK resident has got a personal allowance of 12,570, and this is tax-free. So you don't pay any income tax on that amount. The next level of earnings up to 37,700 are taxed at 20%. Then the next level, that's called the basic rate tax. The next banding is called the higher rate tax, which is for earnings up to 125,140, and this is taxed at 40%. And the additional rate of tax is for any earnings above 125,140, and this is taxed at 45%. It's important to note that for every £2 earned above £100,000, you lose 1% of your personal allowance, so that by the time you have hit £125,000, then you haven't got any personal allowance left, and the starting rate for your taxes is actually 20%. The next level of taxes to be aware of is the national insurance contributions. These will also be deducted from your salary before you get your net pay. And the bands for Class 1 national insurance are as follows. The lower earnings limit is 6,336, and earnings below this level do not attract national insurance contributions, but also do not give you a qualifying year for state pension. So in order to get a qualifying year for state pension, you need to pay yourself above the lower earnings limit. The primary threshold is the rate at which employees start to pay national insurance. And you can see this is 12,570, and earnings above that are taxed at 8% for national insurance contributions. The secondary threshold is 9,100. This is the level at which employers start to pay national insurance contributions, and earnings above 9,100 are taxed at 13.8%. Now, for employees, there's something called upper earnings limit. The upper earnings limit is the limit beyond which they stop taxing you at 8%, but instead reduce your national insurance contributions to 2%. And an important thing to note about state pensions there is that for you to get a qualifying year for state pension, you must earn above the lower earnings limit. The next piece of the puzzle is employment allowance. Now, this is not a tax, but it's actually a relief. Employment allowance can be claimed where there is more than one person on the payroll. The first sentence being true means that it is not available for sole directors. So if you are the only director on your payroll, then you cannot claim employment allowance because it requires at least two people on the payroll who could both be directors, or it could be a director plus an employee, but it definitely requires more than one person on the payroll. The employment allowance for 2024-2025 is £5,000, and this is a pot of money that can be used to offset any national insurance contributions that are payable by the business. Yes, and this can be used to reduce the amount of Class 1 national insurance contributions payable to HMRC. And to claim this allowance, you can do this using your payroll software when you file your employment payment summary, the EPS, or you can ask your accountant to do this for you. The next type of tax that comes into play is corporation tax. Companies pay corporation tax on their profits, and profits are the total earnings, total turnover by the company less the allowable expenses. So it's not everything that the company has earned, but the profit after deducting the allowable expenses. So the corporation tax rates to be aware of, because this helps us understand the benefits of doing one option versus the other. The small profits rate, this is for profits that are less than £50,000 in a year, and this is 19%. The main corporation tax rate is 25%, and this is for companies that earn a profit of £250,000 and above. And between those two figures, so where a company earns a profit of 50,001 and just below 250 is what is called the marginal relief rate, which is calculated as a proportion. So starting off with 90% and adding a percentage so that the actual corporation tax paid is somewhere between 19.1% and 24.9%. And the final item that comes into play is dividends. So I recommended that the best way to pay yourself as a director is a mixture of salary and dividends. But it's important to explain what dividends are before we can talk about how they are taxed. Dividends are paid to shareholders from reserves. So you could be a director, but you're not a shareholder. That means you can't get dividends. But it's also important to note that dividends are paid from reserves. Sorry, bend that back. And reserves are the current year's profits less corporation tax, or it could also be the accumulation of profits retained from previous years. So reserves, for you to find out how much is available to pay in dividends, you must have set aside the money to pay corporation tax, and then that is your reserve plus any other reserves that have accumulated in the company from previous years. Dividends can be paid monthly or quarterly or annually, or it can also be paid at the end of the financial year, final dividend, but it is advisable to work out what your dividend is before the end of the financial year to avoid getting yourself into a situation where you have declared illegal dividends. So illegal dividends is where a shareholder takes out dividends, but there are actually not enough reserves in the business to be able to pay this. There are penalties for declaring illegal dividends, and it could leave you paying a lot more tax than you need to. Dividends are taxable. Even though they are paid after corporation tax, the person who receives dividends pays tax on them. And for the year 2024-2025, the tax-free dividend allowance is £500. And the rates for taxing dividends depend on the tax band, depending on how much you've taken and which band that dividend fits in. If it fits in under the basic rate tax, the dividend tax is 8.75%. If it fits in under the higher rate tax, the dividend tax rate is 33.75. And if it fits in under the additional rate tax, the dividend tax rate is 39.35%. So, having considered all those different moving parts, the income tax, the national insurance contributions, the employment allowance, the corporation tax, and the dividend tax, my recommendation for the best salary to pay yourself as a company director for the year 2024-2025 is $12,570 per annum, or $1,047.50 per month, or $241 per week. This is the most tax-efficient amount for the majority of directors to pay themselves. Any additional pay should be paid out as dividends. And at $12,570, this figure is above the lower earnings limit, so that you qualify for state pension. You get a qualifying year for state pension. But also, it's important to be aware that at this rate, it is above the secondary threshold, which means the company will need to pay Class 1 national insurance at 13.8% on the amount above the secondary threshold. The amount payable for that is $478, but the savings in corporation tax far outweigh this. I'll take you through the calculations in the next spreadsheet, but it's definitely worth paying yourself $12,570, paying national insurance on it, because you will save more than the 478 when it comes to calculating your corporation tax at the end of the financial year. And also to be aware that if there's more than one person on the payroll, that national insurance can be claimed from the employment allowance, in which case there is no additional tax to pay. But obviously, it's to remember that the 5,000 employment allowance is available as a pool, not just for the directors, but also for any other employees that the company might have. I've had a few people ask me, what if I don't want to pay any tax on my salary at all? If for you the benefit of paying 12,570 and then paying the class 1 national insurance is you're not convinced that that is a good strategy, you can pay yourself just below the secondary threshold, which is 9,100 a month. Sorry, 9,100 a year, which is 758 a month. At that rate, there will be no income tax to pay and there will be no national insurance to pay, but you will still have a qualifying year for state pension. But it means your savings on corporation tax will be lower than if you had paid yourself at the amount that we are recommending. So that's it from me for part 1. I hope you find that helpful. I will be back with part 2 to this video, where I will take you through the workings of the different payment levels. I'll work it out at £25,000, at £50,000, at £100,000, and at £125,000, taking into account salary only and a mix of salary and dividends, and just to demonstrate which strategy is better and by how much, and the impact both on the company and on the director. If you would like to find out more about how we can help you to pay yourself more efficiently, or just to manage your payroll or your finances a little bit better, or for advice on anything you've had in this recording, please get in touch via our website, which is gHawkaccounting.co.uk/contact. Thank you for watching.